The Trade Desk is a company that has had a terrible 2025. Year to date, the stock is down by over 65%. And they just announced their earnings back on November 6th. And from that time period till now, we've seen the stock fall an additional 12%. However, in my opinion, the earnings that the Trade Desk released are not that bad. What was bad is what we have seen from some of their competition. But before we get into all of that, let's take a look at a couple of different things. First off, the Trade Desk, if you aren't familiar, is an advertising platform that helps advertisers better target their direct consumers. And in today's world, there's so many different platforms that capture people's attention. So advertisers need to be present with their ads on all of these different platforms, whether it's social media advertising, Google ads, TV, audio, whatever it may be. The Trade Desk helps these advertisers target their customers. And this is a company that has not only attracted a lot of retail investors, but it's even gotten the attention of some much larger investors, specifically Kathy Wood. Kathy Wood right now holds it in her ARK ETF. It only makes up a little over 1% of the portfolio, but she does hold this position and she has been adding to it recently. But one thing I always say is don't buy a company just because someone else did, whether that person is a random YouTuber or even a super investor. The reasons you should be buying a company is because you believe that a company's fundamentals are going to continue to improve over time. In the case of the Trade Desk, if we look over the last 5 years, this stock is down by over 50%. Back in 2020, it was trading for around $80 per share, and today it is trading at $40 per share. And over the past 5 years, we have certainly seen the fundamentals for this company improve. Back in 2020, they had a trailing 12-month revenue of $836 million. Here today, that has over tripled to $2.7 billion of trailing 12-month revenue. And for bottom line numbers, we see a similar situation. Their trailing 12-month EPS at the end of 2020 was sitting at 49 cents. Here in 2025, we can see that they are now bringing in 83 cents of EPS for the trailing 12-month period. So this is about doubled over the course of the last 5 years. However, the stock price has been cut in half. And of course, this is where valuation can be important because back in 2020, on a trailing 12-month basis for EPS, investors were willing to pay around 163 for a trailing PE ratio. Here today, the PE ratio for the Trade Desk has dropped all the way down to a 50. And ultimately, the reason we have seen the compression around the Trade Desk valuation is due to increased competition. Specifically, a lot of analysts have been calling out increased competition from Amazon. And this concern from investors continues to materialize as Amazon announced that advertisers will be able to buy ad space on Netflix, Spotify, and SiriusXM through their ad platform Amazon Ads. And Amazon Ads is slowly turning into a major piece of Amazon's business. Everyone right now is talking about AWS. And in their most recent quarter, AWS grew their revenue by 20% year over year. However, the fastest growing segment of Amazon was not AWS. It was their advertising business, which grew by 24% year over year. And as of this most recent quarter, advertising makes up almost 10% of total sales for Amazon. But what about the Trade Desk? In terms of their most recent earnings, they posted revenue of $739 million. That was up 18% year over year. The only bad thing about that is growth is very clearly slowing down because a year ago, they were growing their top line by 27%. However, they have seen their margins increase slightly to 16% compared to 15% a year ago, and GAAP EPS is now sitting at 23 cents compared to 19 cents a year ago. But what I found most interesting about this earnings announcement is the introduction of a new chief of revenue officer. This man is joining from Google and he has 25 years of experience in the advertising business. Growing advertising at Google is a very impressive feat. And if he can bring a lot of those expertise to the trade desk, this could be a key acquisition to their team to get the company back on track in terms of growing their top line by 20 plus percent. And I've talked about this before, but one of the most important things for valuation is revenue growth. When investors see high revenue growth companies, they are a lot more likely to pay a premium to invest into those companies. This has to do with the fact that if a company can continue growing their top line by 20, 30, 40%, then they will expect that in the future they can convert that revenue into stronger bottom line growth numbers. So they're willing to pay up on the front end for that expectation of growing the bottom line in the future. Right now, the trade desk, according to Yahoo Finance, is sitting at a forward P ratio of a 31.25. This isn't fully accurate. We'll take a look at why here in a second, but the PEG ratio is currently sitting at a 1.25. This is fairly reasonable. Right now, I like buying companies below a 1.2 and ideally below a 1. So a 1.25 is fairly reasonable for a company that should continue growing their top line at a quick pace. So the reason that I said their forward P ratio of a 31.25 is not fully accurate is because, of course, it depends on your earnings estimate over the next 12 months. If we look at analysts right now, for 2026, they're expecting $2.08 of EPS. That means that the trade desk right now is trading closer to a 19 to a 20 forward P ratio based off the average EPS estimate for 2026. And we will dive a little bit deeper on these other estimates here in a second, but I did want to point out that in 2026, for top line numbers, analysts are expecting revenue to grow by 16%. In my opinion, this could be a little bit low. We've seen a lot of different things occur throughout 2025 with tariffs, as well as a lot of concerns around the macro economy, interest rates, things like that. And in 2026, we could see things start to turn around, especially if we see interest rates continue to drop, and that could spur on some additional advertising spend for a lot of companies. So in my opinion, I think this number is probably conservative. They could grow by 20%, maybe even 22% in my opinion in 2026. But let's jump back to earnings. So again, on the average side, analysts are expecting $2.08 of EPS. That means a 19 forward P ratio for the company and earnings growth year over year of about 17.5%. On the low end, analysts are expecting $1.68 of EPS. That would be a drop in earnings of 5%. And then on the high end, they're expecting $2.40 of EPS. That would be growth of the bottom line by 35%. If we see these low underperformed numbers of around $1.68, we could be talking about a valuation between 12 and 20. Personally, I don't think this EPS is very likely, but if they were to trade down to these valuations, again, somewhere around a 15 forward P ratio, that could result in a stock price of $25 per share. But on the high side, if they put up $2.40 of EPS, again, that would be growth of 35% year over year. If they are growing their bottom line that quickly, they should easily trade between a 30 and a 40 forward P ratio. So if we just average that out to a 35 forward PE, that would result in a stock price of around $84 per share. In my opinion, I do think this average EPS estimate is most likely for the trade desk in 2026. If I had to put my range on it, I would say somewhere between $2 and $2.15 of EPS in 2026 for this company. At that point, we could see them trading in line with the broader market at a 25 forward P ratio, resulting in a stock price of around $52 per share. But one thing to consider is even if EPS comes in around $2 to $2.15, if we see their revenue growing by 20 to 25%, we could see a higher valuation on this company, maybe a 30 or even a 35. If they were to trade up to a 30 forward P ratio, that would result in a stock price of around $62 per share. So, in my opinion, right now, I think the trade desk is trading at the lower end of a fair valuation for the company. So, I don't think it's quite yet into the undervalued range. I think it's just kind of somewhere towards the bottom of what a fair value would be for the company. Right now, I do not hold any shares of the trade desk in any of my portfolios. This is the YouTube portfolio, and right now it's sitting at a total value of almost $84,000. And really, the main reason I don't hold it in my portfolio is one, again, I don't think it's severely undervalued, so I haven't bought into it. But also, two, I hold Google as well as Zeta in my portfolio, and these are two advertising companies, right? Zeta obviously does advertising kind of similar to what the trade desk does, but we also have Google, which is obviously a huge advertising company. And in my other portfolio, I hold a large amount of shares of Meta. So I'm kind of already exposed to the advertising market. And oftentimes, if we do see a pullback in the broader market, advertising gets hit very severely. So I don't want to be overexposed to that industry. But of course, let me know your thoughts down below. Do you hold any of the trade desk in your portfolio? What is your price target for 2026? And do you think the trade desk can get back above 20% revenue growth year over year? Let me know down below. And while you're down there, drop a like on the video and subscribe for more videos like this one. And as always, have a wonderful rest of your day.